I wanted to make this quick video about Realty Income since it has been in the news this past week because of its recent acquisition. What does that mean for Realty Income in the long run? Will this affect its dividend payout? Hi everyone, if you're new here, my name is John and this is Talk Finance. Today, we are talking about Realty Income's new acquisition. If you want a more in-depth review on Realty Income, you can find it on my channel from a video I made a week ago. I know I just made a video about it, but I released it before the new update, so if you want to watch it, I will add the link to the video up here. Watch this video, then go watch the review on Realty Income. Okay, back to the acquisition. Realty Income has signed a definitive agreement with subsidiaries of CIM Real Estate Finance Trust, which is a non-listed REIT, sponsored by an affiliate of CIM Group, to acquire up to 185 single-tenant retail and industrial properties. The move resonates with the company's expansion efforts in key markets to enhance portfolio quality and scale. I do want to mention that shares of Realty Income were trading higher today. The market closed yesterday, January 3rd, at $63.80, and Realty Income share price at close today was $64.61. But I don't think the news of this acquisition has been baked into the price, since the overall market was up today as well. So most of your shares were probably green. According to Realty Income's website, the transaction of the 185 properties is expected to be executed at an approximate 7.1% cash cap rate for the total portfolio, which means that the 7.1% cash cap rate is their expected return in a one-year period. Many real estate advisors would say that a cap rate between 5 to 10% can be good, but that would depend on the market you are purchasing and the quality of those properties as well. The weighted average remaining lease term is approximately 9.2 years, with approximately 48% of total portfolio annualized contractual rent derived from investment grade rated clients. That means that half of the tenants in this new properties are high quality tenants that care to keep their investment grade rating to access better loan options. But 185 commercial properties has its pros and cons. A pro is it's a big purchase that can bring more cash flow and future property value growth, but a con is they are putting a lot of cash up front in properties where only half the tenants might be able to pay, therefore affecting the dividends in the long run. But that is also a pro. Having so many properties and in different tenants can diversify their portfolio even more, not just making it more secure, but allowing them to keep raising their dividends in the future as they collect rents and they have property value increase. Let's look at the tenants this new purchase brings with them. And while I list out the names, if you could take a second to give the channel a like, it is very much appreciated. And if you like the channel enough, consider subscribing. Okay. Here it says the top 10 clients concentrations for the portfolio are estimated to be Lowe's with 8 properties, which is a great new tenant for Realty Income who last quarter reported an EPS and revenue beat. Walgreens with 14 properties, which Realty Income also has buildings of. United Oil with 15 properties. Bob Evans with 20 properties, which is a well-known breakfast chain in the Midwest. Kroger with 5 properties. CVS with 10 properties, which expands a tenant that they already manage as well. Hobby Lobby with 5 properties. Kohl's with 3 properties. This is a tenant that does worry me a bit by how they have been performing and how much pricing power the store might actually have if they need to compete with online retailers and other brick and mortar competitors. CarMax with 1 property, and National Tire and Battery with 8 properties. This is 89 out of the 185 properties, so it would be interesting to find out what the other 96 properties will be. Lowe's and Walgreens are expected to represent the top 2 clients by total annualized contractual rent at 11.9% and 7.6% respectively. This new acquisition will increase their property rentable space by 4.6 million square feet, which 55 of those are retail clients, who in total will represent 95% of the total portfolio annualized contractual rent, and 4 industrial clients representing the remaining 5%. This hasn't been finalized, so some of the details could change for Realty Income since they are able to review each property as they complete their due diligence, which we would hope they would do as well. But I think Realty Income is thinking into the future and expanding their portfolio, which I believe could give them more financial flexibility and position them to capitalize on long-term growth opportunities. You won't see an increase in the dividends all of a sudden, but you will see a company that's positioning themselves to be able to maintain a dividend increase into the future like they have been doing. If you enjoyed the video, please give us a thumbs up by hitting that like button. And while you're at it,